Stocks tumble as persistent inflation crushes hopes of a Fed rate cut anytime soon. Welcome to Market Insights. Wall Street sank this Thursday, with the Nasdaq down over 2% after underlying inflation came in at 3.7%, leading bond markets to scale back their expectations for a rate cut from the Fed. They're now pricing that in for November. It's also the moment of truth for big tech this week, with Microsoft and Alphabet reporting after the bell, as Meta platforms fell after disappointing numbers last night. Well, to dig into this, I'm now joined by Matt Miskin, Co-Chief Investment Strategist at John Hancock Investment Management. Hi, Matt. Thank you so much for joining us. Now, the big question this week was whether big tech would deliver the numbers to justify its valuations. Meta obviously couldn't. Is that a warning sign for investors in the sector?
We do think that technology companies need a breather here after such a great run. And what we're seeing is the earnings results are actually coming in really great, but it's hard because there's already so much priced in. And even though they beat and revenue was good, the outlook wasn't as strong. And so really you need to have everything going right to basically justify these valuations. We think the part of the market needs a breather here, and we're likely to see a market rotation start to develop.
And what are you expecting later from Microsoft and from Alphabet?
Similar story, frankly. We don't think their earnings are going to be that bad. These are very well-run companies, great margins, great balance sheets. But then again, the question is, how much is already priced into the stock? And are they going to be able to provide that outlook, that guidance that is going to suggest even further growth on top of what's already been priced in? We have started to find some of these stocks to be overvalued. We do like high quality companies. We're starting to look at other parts of the market. For example, energy, utilities, things that have gotten not as much love might actually be starting to get more attention given some of these earnings reports.
Now, the bond market is now pricing in just 1/4 point cut in the Fed funds rate for all of 2024. How can stocks adjust to a much more hawkish Fed?
Well, they could go lower. If you look back to where the Fed actually had started talking about rate cuts back in about October of last year, that was the low in the market. And we saw an explosive market over the last 6 months because the Fed had basically used forward guidance to say we're going to cut. Well, now they almost have to counteract or unwind that easing that they had placed into the economy and markets. And the markets aren't going to like that. It's going to place a higher cost of capital for companies, a higher discount rate for forecasted cash flows, and it's going to make bonds more attractively valued. We actually think there's great opportunities in the bond market. It's tough because the momentum's against you, but high quality income of around 5 to 6% over the next 5 to 7 years actually sounds pretty good to us.
Now, today's inflation data was still high. Is it possible the Fed may not even be done with hiking rates?
Yeah, and this is about, again, talking about rate cuts before they should have now might mean that they need to overcompensate and actually suggest a rate hike is warranted. If they hadn't talked about cuts, they might have to probably wouldn't find themselves in this position where they have to talk about a hike. But at a minimum, we think they're going to be much more hawkish. We think they got to put that on the table that a hike could be warranted. And that should be enough forward guidance. But we'll have to see if the inflation data keeps coming in strong like this. You can't rule it out.
Matt Miskin, Co-Chief Investment Strategist at John Hancock Investment Management. Thank you so much. Now that is your Market Insight. You can watch more videos on Reuters.com.